Hello, and welcome to Calmvestor Podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Have you ever heard stories of people who seem to know exactly when to buy or sell a stock, making a fortune overnight? It often makes you wonder if they had some secret information. Consider the infamous case of Enron, where executives hid massive debts and inflated earnings, leading to devastating losses for investors who were kept in the dark. Or Martha Stewart's well-known insider trading case. This brings up a crucial question. Is it fair when some individuals possess an informational advantage that others do not? What happens to a financial market if transparency fades? Information is power, especially in finance. An imbalance of information can have severe consequences, not just for individuals, but for the entire market's integrity. As Von Janjigian noted, an efficient market is one where stock prices quickly reflect all available information. But what happens when this information is not fully or fairly available to all? Imagine an individual investor buying a stock at its peak, just before the company announces bad news and the price plummets. Meanwhile, rumors swirl that big players sold off their shares beforehand. This is the world of asymmetric information. But what exactly is asymmetric information? Simply put, it occurs when one party in a transaction has more or better information than the other party. This imbalance can arise from differences in access to data, the ability to analyze it, or when one party deliberately conceals or provides misleading information. There are several common forms of this in financial dealings. Insider trading is a classic example, where trades are made based on confidential, non-public information. Then there is the concealment of information, like a company not fully disclosing negative news, or the spreading of false rumors to manipulate prices, a deceitful tactic. Sometimes, experts might exploit their knowledge, like a broker advising unsuitable products to earn higher commissions, taking advantage of a client's trust. It is important to distinguish between diligently researching to gain insights, which Philip A. Fisher notes is key for successful investors, and illegally using non-public information. One is skill, the other is a breach of ethics and law. Warren Buffett emphasizes the importance of transparency, stating, "What needs to be reported is data, whether it is GAAP, non-GAAP, or beyond GAAP." This highlights the need for honest disclosure. The negative impacts of asymmetric information are far-reaching. For individual investors, it can mean significant financial losses from decisions based on incomplete or false data. It can also erode trust in the market. As Anthony Robbins points out, the market can feel like a giant casino when people feel they are gambling against those with an unfair edge. This naturally leads to feelings of injustice and being exploited, which can deter ordinary people from participating in wealth creation opportunities. For the market itself, asymmetric information reduces efficiency. Prices may not reflect true value, as not all information is incorporated. It also increases volatility and risk. Vahan Janjigian mentioned that companies not providing clear guidance can be more volatile. This uncertainty creates an environment ripe for price manipulation and unfair competition. On a broader economic scale, capital can be misallocated, flowing to undeserving ventures instead of productive ones. This hampers overall economic growth and efficiency. Ultimately, it can lead to a decline in public participation in capital markets and an erosion of business ethics, which is detrimental to long-term prosperity. Warren Buffett once quipped, "The only value of stock forecasters is to make fortune tellers look good." While about market prediction, it hints at the danger of relying on information from unclear or unequal sources. But why is asymmetric information such a persistent problem? One reason is basic human nature, the desire for an advantage, for a shortcut. As Burton G. Malkiel noted, humans tend to seek patterns, even in random events, fueling the hunt for special information. Financial information itself is inherently valuable. Knowing something before others can translate into enormous profits, creating a strong incentive to acquire or exploit such information. The complexity of financial markets, with their many layers and participants, also makes it difficult to control the flow of information and detect illicit activities. While laws against insider trading exist, detection and proof are challenging. Sometimes, disclosure regulations are not strict enough, or companies find ways to obscure details, as Buffett pointed out regarding some firms merging business segments to confuse investors. Furthermore, The speed at which misinformation can spread in the digital age through social media and forums adds another layer of complexity. False rumors can go viral before they are debunked. Eugene Fama's research, cited by Malkiel, suggests that markets cannot always instantaneously absorb information and adjust prices, creating windows of opportunity for those with early or better information. So what can be done to address this challenge? For individual investors, the first step is enhancing financial literacy. Understand how markets work and how to analyze information rather than just relying on rumors. As Philip A. Fisher stated, skilled investors can acquire information that ordinary people cannot through diligent research. This is about equipping yourself, not about unethical access. Diversifying your portfolio is crucial. Do not put all your eggs in one basket. This reduces the risk from any single stock or piece of unverified information. Adopt a long-term mindset. Anthony Robbins clearly distinguishes between short-term speculation and long-term investing. Avoid trying to time the market based on short-term news or tips. Always verify information. Question the source and reliability of any tip or news. Be skeptical of secret or insider information from unclear origins. Brian Tracy advises to be careful with all insider information or investment advice. It's crucial to do your own homework. Before investing, learn everything you can about the company, its management, competitors, and prospects. Patience and discipline are key. For regulators and companies, increasing transparency is paramount. Companies should be required to disclose information promptly, fully, and accurately. As Buffett says, what needs to be reported is data. Stricter regulations against insider trading and market manipulation, along with robust enforcement and severe penalties for violations, are essential to deter unethical behavior. Encouraging detailed financial reporting helps investors understand a company's operations better, rather than being confused by overly consolidated or opaque statements. The role of independent auditors and oversight organizations must also be strengthened to ensure accountability and adherence to ethical standards. While Vahan Janjigian mentioned that the decision to provide forward guidance might rest with company management, this must be balanced with investors' need for adequate information to make informed decisions. In conclusion, a healthy financial market is built on trust and fairness. Asymmetric information is not just a legal issue, it is a profound ethical challenge. Every investor, by equipping themselves with knowledge and acting responsibly, can protect themselves and contribute to minimizing the negative impacts of information imbalances. It requires a collective effort from businesses, regulators, and investors to move towards a more transparent, efficient market where everyone has a fair opportunity. Our vision should be a future where information is shared more equitably, and advantages come from diligent analysis and insight, not from unethical foreknowledge. As Vahan Janjigian also said, in stock trading, there are no certainties. However, through decades of research, researchers have discovered which investment strategies are most effective. Let us strive to win through knowledge and ethical strategy. Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.